Welcome to Stock Talk with Nico Criticos. Today we're going to be going through some midstream oil and gas pipeline companies. I'm going to give you my top four, and we're going to compare them all and find out which one is the best to invest in. So the four we will be discussing today are Kinder Morgan, Mplx, Energy Transfer, and Enterprise Products. Now, I have owned, these are all high dividend paying stocks. I've owned Enterprise Products for a little over a month now. I believe I bought it in at about $21. So I do own that one, but I'm kind of thinking about selling that and buying some other ones. I want to own two out of these four. So that is what I'm considering. And this is just, I want a place to store some money, not have to worry about it, and receive high dividends. And these all pay somewhere between a 6 to 9% dividend. It's also worth knowing that in the last year, energy was, I believe, the first or second most popular sector, most successful sector for the past year. I think that and financial services were the top two. So energy has had a great year, and 2022 is also expected to be a good year for energy because things should get more back to normal and more things should be opened up, and things like jet fuel and oil and gas, all that stuff should be closer to back to normal. So let's get started with this. So first up, we have, what I did was between these four stocks, I compared the forward PE, the price to sales, the market cap, the beta, the dividend, and the payout ratio, the 2022 expected growth numbers, as well as 2021 growth numbers. Do they have growing equity? Yes or no? The amount of pipeline miles that they have. And this is for Kinder Morgan and for Energy Transfer. It's for total pipelines miles. It's not just for natural gas pipelines. So, but these other two, I'm not quite sure. I'm not sure if it's just for natural gas or if it's for everything. So next up, then we have profit margin. Then we have a PEG ratio, enterprise value to EBITDA, return on invested capital, average return on capital, the share change over the past year, and the number of insiders that bought the stock in the last 6 months, I want to say, or 6 months or a year. So let's get started with this. So what we have here is, and the things that I've highlighted in green mean that stock got either it's first and second place for each category. Okay, so forward PE, that goes to Mplx with a 9, and as well as Energy Transfer with a 6. So Energy Transfer is trading the cheapest on a forward price to earnings basis. Price to sales, we have Enterprise Products as well as Energy Transfer. And then the biggest one here, the other thing I want to point out is that I also want the two companies I invest in, I want them to be, that's why I put market cap and beta, because I want them to be bigger companies that are less volatile, safer, and everything like that. So that's why I have, so Kinder Morgan and Enterprise Products have the lowest beta. They also have the highest market caps. And then Mplx has the highest dividend of 9%. They all have, 3 of these have over 100% plus payout ratio, which is not good. But one thing I noticed with all these companies is if you look at the last couple of years of revenue and income, they're not very steady. Even the big ones, like this is Kinder. Let's go. Any of these, they're all very similar. But if you look at their revenue and income numbers, they're pretty volatile. So this company lost money in 2020, and this year things are looking good. This past year, the numbers are strong, but still volatile. And the weird thing about this too is that would make sense if the company's success was based off of the commodities product. So a lot of these, like Kinder Morgan, they don't just do natural gas. It's like gas, oil, carbon dioxide, and there's multiple different commodities that they run through these pipelines. Okay, but the amount of money these companies make is not based off of the price of the commodity. So if a barrel of oil goes up or down in price, it's not going to directly affect the money these companies make because they're not charging based off of the commodities price. But the way that it will indirectly affect these companies' success is, if you think about the cheaper the commodity is, then that means more people are going to be selling, right? And if the product is very expensive, that means it's going to be that means it's more bought into, right? So one way it will be affected is how busy, or how, I guess, just regular supply and demand of the commodity. So that's one thing you got to take into consideration. And but going forward, I guess that's just, you got to think about what makes this company successful, and you're not going to get any of these companies too steady. They all pretty much have volatile years. As far as their growth numbers, you can see a company like Energy Transfer did 69% revenue growth last year, and they're expected to do 6% this year. Equity, that means just are they growing equity? That's why I was kind of disappointed with Kinder Morgan, with them being the biggest and the least volatile, and not the most amount of pipeline miles, but their equity has not been growing. It's been shrinking the last 3 or 4 years, so that's not very good. Pipeline miles, also a very important metric, because Energy Transfer has the most. Kinder Morgan is also very high up there. And that just means, market share and the amount of dominance they have in the industry is a very important thing. It kind of serves as a moat. It kind of gives them a protection. Next up, we have the profit margins. You can see three out of the 4 of these companies have anywhere from 9 to 12%, but then Mplx does have a 32% profit margin. I'm not sure if that's just a one-time thing or what, but that's pretty high compared to the others. Next up, we have a PEG ratio. This is price to earnings growth. This is a pretty useful metric to use as well. Energy Transfer has extremely low of a PEG of 0.1, which is just crazy. Same thing with Kinder Morgan. Enterprise Products of 18 does not look very good, which is kind of threw me off a little bit, because that's insanely high. Then we have enterprise value to EBITDA. These are all pretty normal, anywhere from 6 to 10. Return on invested capital for this last year, anywhere from 5 to 8%. Mplx took the lead with that one. Same thing with average return on invested capital. I guess you could even give, this one should get a green too, which would give EPD another point. Average return on invested capital, Mplx averages 12% over the last 20 years. So that was very surprising, kind of. That's a very strong number. And then you see Kinder Morgan with 2% and Energy Transfer with 2%, not very good. Share change doesn't really, they're all pretty close to zero. The amount of shares kind of stayed the same the past year. Insiders bought. This one is kind of interesting, because it looks like Mplx and Energy Transfer have the most amount of insiders, but then when you see you'll see my notes coming down here, you're going to see that one of them actually has a lot more purchases from insiders over the last 6 months. So, but anyways, so here's my top 4. In fourth place comes Kinder Morgan, ticker KMI, with a score of 5. Okay. And they have the largest natural gas transmission network in North America, which is, at first I really wanted to buy that stock just because of that reason, because of their market share, the amount of pipeline miles they have, and that the fact that they're the largest in North America. That's a big moat right there. 60% of revenue comes from natural gas. Natural gas is, the other thing I want to address in this video is that, yes, I know there is a big, the future trend is going towards renewable energy and electric and solar and wind power and all that. And I totally believe in that. I've been an investor in Tesla. Tesla's my biggest position, and it's been my biggest position for the last 3 years now. So I'm a total believer in that, but I do think it's going to take a while to fully transition to that. And I think gas is, I think things like coal are going to die out sooner. So I think natural gas is going to be around longer, at least another, 10, 20 years of natural gas playing an important role in our economy. And so that's what you have to keep that in mind is, yes, I know things are transitioning to renewable energy, to green sources of energy, but natural gas is not going away anytime soon. It's going to be a strong part of the economy for the next decade or two. Then next up, we have Kinder Morgan is the only company here that's in the S&P 500. That's also a big plus, big advantage for this stock, because it's going to, when people invest in the S&P indexes, that's going to push Kinder Morgan up as well. It's always nice having your company be in the indexes. That's a big advantage for your company. So that's one thing that Kinder Morgan does have. But they have a bad balance sheet. As I said, equity was shrinking, and that's really, they have the worst balance sheet out of any of these companies. So Kinder Morgan gets fourth place. I do not plan on buying that one. They also have the lowest dividend, and revenues are expected to drop 14%. So not looking too great. Next up, we have in third place Mplx with a score of 8. And this is the one I was referring to when I said in the last 6 months, there's been 30 insider purchases and only 2 sells. So I guess honestly, we could change this to 30. Well, that's the amount of purchases. I think this is the number of insiders that bought, but or was that was a 7? Okay. Then the other advantage for them is they have the highest return on capital average of 12%, which is, as I said before, very high, especially compared to these other companies. Look at in second place, Enterprise Products of 7. And then they also have the highest dividend of 9%, which also is a very attractive add-on for this. Next, the final thing is that the stock is near a 52-week high, which is actually a weakness. So I'm not interested in buying this at a 52-week high. Even this could run up another, it's possible it runs up another 20 or 30% this year, but I don't like buying things when they're at their 52-week highs. I don't like that. So if this was to come down maybe to like $27, then that would be much more attractive, but not at these prices. I don't want to buy. And that's why this one came in third place instead of second, kind of, because that was a big reason. This next one in second place is very close to Mplx, and that is EPD. So EPD should actually have a score of 6 now, but Mplx had a higher score based off of these tables here. But here, this is why I'm more bullish on Enterprise Products, and this is the one that I already own. So 63% of cash flow goes back to shareholders on average through either share repurchases or through a dividend. Okay, this company pays a 9% dividend, I believe, or no, 8%. Yeah, 8%. And they've been growing their dividends for over 23 years, which is also a big plus. So they have a good track record. This company, price to sales of 1, very healthy. Forward PE of 10, not bad at all. Market cap of 52 billion. Let's see. So is this is the other reason. Market cap of 52 billion. They're the biggest company here. That is a huge benefit. Beta of 1.3, very low. That's not going to be too volatile. That's perfect. Dividend payout 8%, super strong. 100% payout ratio. I mean, not good, but compared to the other ones, it's normal. And then I'm not too worried about the growth numbers. I mean, this is just going to fluctuate with whatever the economy is doing at the time. Equity is good. Pipeline miles of 51,000. That's very strong. Profit margins right in average. PEG ratio this is the only thing that throws me off. Why is the PEG ratio 18? That's weird. Enterprise value to EBITDA, just an average. Return on invested capital 7%. And yeah. So the other thing with this is, so they have 50,000 miles of pipelines combined, and they're also the world's largest exporter of liquefied petroleum gas. And it seems like that is a very popular commodity now in the past couple months because it's a cleaner source of energy. Okay, so that's why even though it has a lower score for Enterprise Products, I really do like this one. I'm probably going to keep this one in my portfolio, and then I'm probably going to buy this next one that's in first place. So first place is Energy Transfer. And here is the 1-year chart for Energy Transfer, not at a 52-week high, but also not at a 52-week low. So somewhere in the middle. And they have 5 core segments and of revenue, and no segment contributes more than 30% of adjusted EBITDA. So that is an excellent thing going for this company, because that's going to lower the amount of risk and the amount of volatility for them. I like seeing that in a company when they have multiple sources of revenue and not one of them is too big of a part. So this is perfect. I saw the table. They're all like in the 20 to 25% range. So this is perfect. And then they also have 20%. I think they said they are involved in 20% of all global natural gas line exports. So that's also a big thing too. So yeah, this is the only one that this is the lowest forward PE, the lowest price to sales, a market cap right in average. The only thing I don't like about this is the beta. The beta is high on this one, but But oh wait, let's see. Yeah, that's the only thing I don't like. But the dividend payout 7% is average. 34% though is very healthy. That's the difference between the rest of these. Their payout ratio is much lower. That's a good thing. Huge growth numbers last year. 69% revenue growth last year. That's crazy. Then equity looks good. The most amount of pipeline miles, 114,000 miles of pipeline in the world. So big plus there. Lowest profit margins, not a fan of that, but it is what it is. And PEG ratio of 0.1, incredibly low. And 11 insiders bought the shares in the last couple of months. I'm pretty sure it was in December. I think December. So another thing in the news right now with them that is looking like bad news, but it could be good news, is Energy Transfer was supposed to merge with Williams Company, and see that now since they abandoned it for, let's see, it was a $33 billion merger with their rival Williams, and Williams does the same thing. Now they're paying $410 million fine for that. So that's not too good. That's gonna hurt their earnings. But there's probably a good reason why they did that. They backed out of the merger, so there's probably a good reason why that happened. But yeah, these are my top pipeline companies. I'm going with Energy Transfer for number one. You can see it had by far the highest score, and they're global. They have everything looks healthy, huge growth numbers, everything low valuation, everything looks good. So yeah, those are my top pipeline companies, and I will be investing in the top two, Enterprise Products and Energy Transfer.